Welcome to the Explainer. Okay, today we have a really exciting mission. If you've ever, glanced at the financial news or looked at a banking report, you've probably been hit with this wall of intimidating acronyms. Things like CRR, SLR, and the mysterious repo rate. These terms might just sound like dry financial jargon, but they actually represent the hidden levers that secretly control the entire banking industry, and by extension, your money. So today, we are going to completely demystify them. Okay, let's dive into this. Here is our roadmap for today. 1. The bank's core engine. 2. Enter the central bank. 3. The repo rate dial. 4. CRR and SLR safeguards. And finally, 5. Why these levers matter.
Starting right off with Section 1, the bank's core engine, or how a bank actually makes money. To really grasp how the big macro levers work, we first need to quickly refresh how the basic banking machine actually operates day to day. And at its absolute core, a bank is fundamentally a spread business. It's a remarkably simple concept, really, especially when you strip away all the fancy glass buildings and complex financial products. The bank simply borrows money at a cheap price, lends that exact same money out at a higher price, and keeps the gap in between. That's it. Think of it like explaining it to a 5-year-old. It's basically a lemonade stand. You borrow some money from a friend to buy lemons, you make the lemonade, and then you sell it for more than the lemons cost. That little bit of extra cash you keep, that's your reward. Now, if you're a senior equity analyst, you're going to use slightly fancier words, right? You'd say a bank is a spread business that raises funds through deposits at a certain cost and deploys them as loans at a higher yield, capturing the difference. But the underlying mechanics, literally the exact same as the lemonade stand. Now, what's really interesting about this is how a bank's balance sheet is completely inverted compared to a normal, say, industrial company. In banking, the money you deposit into your savings account, that isn't an asset for the bank. It's actually a liability because the bank owes that money back to you. On the flip side, the loan they give out, that's their asset because the borrower owes them that money. It's totally upside down. Moving on to Section 2, enter the central bank, or as we'll call them, the head teacher. So what happens when we zoom out a bit? If every bank is just a little lemonade stand, the central bank, like the Federal Reserve or the Reserve Bank of India, well, they're the head teacher. Our 5-year-old would say the head teacher makes the rules for all the stands in the schoolyard, just to make sure no one behaves badly or, runs out of money. The equity analyst would say the central bank sets monetary policy and mandatory reserve requirements. Basically, they are the ultimate rulemaker ensuring the whole banking ecosystem doesn't crash. And this head teacher, they have some incredibly powerful tools at their disposal.
Which brings us to Section 3, the repo rate dial, also known as the price of borrowing.
I want you to really think about this for a second. What actually happens when the head teacher decides to change the base price of money for everyone? Because that is exactly what the repo rate does, and its ripple effects spread across the entire economy. Let's go back to our lemonade stand. The head teacher sets a specific price for whenever a stand needs to borrow extra coins from her big money box. If she raises that price, everyone pays more. Simple. For the analyst, this is the repo rate. It's the official rate at which the central bank lends money to commercial banks. It absolutely establishes the foundational cost of borrowing for the entire industry. Let's walk through the domino effect of how this dial works in practice, specifically when the rate is cut. Step 1, the central bank cuts the repo rate. Step 2, the commercial bank's borrowing costs fall. Sounds great, but here's where it gets a little tricky for the bank's profitability. Step 3, the loans the bank has already given out often reprice downward way faster than the bank can actually lower the interest it pays on your deposits. And because of this mismatch, we hit Step 4. The bank's net interest margin, that vital spread we talked about earlier, gets pressured. It shrinks. The head teacher just squeezed the lemonade stand's profits. I absolutely love how our source material sums this up with this brilliant one-liner. The repo rate is the master dial on every bank's margin. Seriously. When they turn that dial up or down, every single bank feels the pinch, or the relief. It is the core monetary policy tool. Let's move to Section 4 and see how this builds. CRR and SLR safeguards, locking away the coins. If the repo rate is the dial controlling the price of money, CRR and SLR are the mandatory safety locks. To our 5-year-old, the head teacher is essentially saying, hey, you must always keep some of your coins locked in my drawer doing absolutely nothing, just to be safe. You can't buy lemons with them, and you definitely can't lend them out.
To the analyst, these are mandatory reserve requirements. They're strict rules designed to limit a bank's lending capacity and make sure there's always a cash buffer in the system, just in case. So the crucial point here starts with CRR, or the cash reserve ratio. This is a very specific percentage of a bank's total deposits that they are legally forced to park directly with the central bank. And here's the kicker. Those funds earn absolutely zero interest, none. For a bank that literally survives on lending money to make a spread, having a chunk of their deposits locked away earning nothing is a massive drag on their efficiency. But it's a completely necessary shock absorber for the system.
Next up, we have SLR, the Statutory Liquidity Ratio. Now, this works a lot like CRR. It's another percentage of deposits the bank just cannot freely lend out to the public. However, instead of sitting as cold hard cash earning nothing, SLR mandates that the bank has to hold this percentage in safe liquid assets. We're primarily talking about government securities here. So it serves a similar safety purpose, ensuring banks have this cushion of highly secure assets they can easily sell off if they suddenly need cash. The source text gives us another perfect summary here. CRR and SLR are mandatory reserves that limit how much a bank can lend. By raising or lowering these exact percentages, the central bank directly throttles the core engine. If they want banks to lend a bit less and maybe cool down the economy, they raise the CRR and SLR. But if they want to stimulate growth and get banks lending again, they lower them. And finally, Section 5, why these levers matter. Controlling the ecosystem. Okay, so we've defined all the acronyms, but what's the massive macroeconomic so what here? Like, why does all of this actually matter to you and the broader economy? Well, the Repo Rate, CRR, and SLR, they don't operate in a vacuum. They work together in tandem as the primary monetary policy tools of the country. By tweaking that master dial of the repo rate and adjusting the safety locks of CRR and SLR, the central bank manages the total amount of liquidity. By that, I mean the actual cash floating around in the market. And this in turn is how they control inflation levels. At the micro level, like we've seen, these moves directly compress or widen the profit margins of every individual bank. And they strictly limit or expand their power to lend money to businesses and consumers. And that leads us to our final thought. The banking industry isn't just some abstract concept. It's literally the financial plumbing of our daily lives. With the central bank sitting right at the top, controlling the master dial of the repo rate and adjusting those safety locks of CRR and SLR, well, how will their next move impact the interest you earn on your own savings account or the cost of the loan you might need for your next home? The next time you see these acronyms pop up in the news, you're going to know exactly what levers are being pulled behind the scenes. Thanks for joining me on this explainer, and keep learning.